get there, we got to bring in our guest. He is Thomas Hayes, Chairman and Managing Member at Great Hill Capital. Thomas, welcome to the Open.
Thanks for having me, Corey. Glad to be here.
We are definitely happy to have you. And look, it's one of the few days where the markets are opening in the green. Now, whether or not they'll stay that way throughout the entire session is yet to be determined. But what do you feel the general sentiment on Wall Street is right now from fund managers and traders?
Well, we really came into this week and it couldn't be more pessimistic, which makes us optimistic. I mean, even if you look at today's prints, we're looking at the AAII sentiment survey. You've got 19.8% bullish. That is less than at the pandemic lows before we had a vaccine, before we had antivirals. You got 53.5% of the survey participants bearish. That's higher than the pandemic lows. You look at the CNN Fear and Greed Index, it's at 14, extreme fear. That's usually a place you want to be a buyer, not a seller if you go back many years. And then finally, the National Association of Active Investment Managers at 19.51% equity exposure, again, the lowest since the pandemic lows. As this market starts to move higher, they are going to have to panic buy and chase performance because they're going to get left in the dust. So, if you look, Corey, at earnings have been strong. As a matter of fact, estimates for 2022 and 2023 have actually gone up consecutively for the past 2 weeks, up. And yet everyone is in the fetal position like the world is coming to an end. And I think the problem is people are looking at these analogs of 2000 tech wreck and saying we're doomed and this is going to go down for the next 3 years. And when you look at the facts are very simple. In 2000, number one, you didn't have the profitability. The companies that aren't making money have already been taken out to the woodshed for the last 12 months. We all know that. But number two, you had a 10-year yield at 6.8%. These companies that were losing money could not borrow. The cost of capital was material. Today, it costs you money if you don't borrow money. We're still in a highly accommodative environment with 8% inflation and below 3% on the 10-year yield. Now we've stabilized in the 270s. It costs you 5% not to borrow. So that is highly accommodative. And even if we see inflation come down to 5 or 4% by the end of the year, which is our base case, it's still a very accommodative environment. So I think it's the Fed has been very successful in slowing growth, as we saw this morning with the GDP report. We also saw the core CPI prices come in lower than expected. So the stage is being set that, as Ben Bernanke says, 98% of Fed policy is talk versus action. The stage is being set for a dovish pivot in the next few months, and that's going to be contingent on the CPI prints coming in moving forward. If inflation comes down, the Fed is going to slow this tightening program, and we're going to be back off to the races. But in the meantime, we wait and see. We look for high-quality companies that are cash generative, that are on sale, trading at steep discounts, and we take advantage when Wall Street throws a clearance sale.
Tom, I'm glad that you brought up the Fed and, of course, what's going on with the tightening, because we have seen some fears. They've sent valuations significantly lower. I mean, yes, they're trying to bring, obviously, the laws of supply and demand back to being in sync with one another. But in your opinion, is it time to start perhaps putting those shopping lists to work?
Yeah, no question about it. I'll tell you, a few of the most hated areas of the market. Value tech, you talk your Intels of the world. Cisco got taken out to the woodshed. Even Facebook Meta is getting hurt off of Snap's guidance cut. I think Snap is more of a discrete situation. I don't know that that's going to be manifest in some of the bigger players. And I think Snap is more vulnerable to TikTok's ascendancy. But I want to kind of put things in perspective because we've been through this before. And the fear is that stocks can't go up when the Fed is tightening. And I'm going to actually disprove that in two particular sectors, which are the two most hated sectors in the market right now. The last tightening cycle was from late 2015 to early 2018. The first hike was in December of 2015. In the 12 months headed into that first hike, the fear of tightening was actually greater than the tightening. The biotech sector, XBI ETF, the NASDAQ equal weighted ETF, sold off 52% in the 12 months, anticipating the tightening cycle, because everyone believes that tech and biotech can't go up in a rising rate environment. China tech, Alibaba fell 53% in the 12 months, anticipating the Fed tightening, which started December 2015. What happened was 2 months after the tightening started, both biotech and China tech found their bottoms. XBI was up 140% over the next 24 months, and Alibaba was up 258% off its lows over the next 24 months. And this was during a period where the Fed hiked 8 times from 25 basis points to 225 basis points and began the balance sheet roll-off, which we're starting in the month of June. So a lot of the fear of tightening and hikes is often much worse than the reality. And I think all that's happened in recent months is it's created some generational buy opportunities for certain sectors, certain stocks, not wholesale, buy the S&P ETF and hope for the best. But I think on a company, high quality company by company and high quality sector by sector basis, there are opportunities to be had that if you look out 3 to 5 years, you could make a real amount of money.
You know what, Tom, while I have you, I've got to get your thoughts on what I call the never-ending Twitter Elon Musk saga. I'm sure you must have lots of ideas on what exactly is going on. So I got to know, what do you make of this latest news that he's going to commit an extra $6.25 billion in his own equity into making sure that this deal is going to be cemented?
Yeah, so last night we saw he increased his equity commitment up to $33.5 billion, but he wanted to get other shareholders to roll in to take down his purchase price. I think there's no way this deal gets done at $54.20 or $44 billion. And the reason is Musk has stated that at least 20% on the low end of Twitter's 229 million accounts are spam bots. That's the low end of his estimates. I think he's going to lowball the company, and he's going to leverage it with fraudulent reporting and discovery, meaning he says, listen, I'm not going to give you 54.20. I'm going to give you 42.0, 420 for the company, and you're going to take it. And here's why. You could sue me to force the deal, but in that lawsuit, there's going to be discovery. There's going to be an external audit. And if they find out that more than 5% of your accounts are spam and bots, which is could be a probability, I'll leave that to the experts, you're going to have a real problem for the board and for the executives that signed off on those public filings repeatedly over years, telling public investors that less than 5% of their accounts were bots, and people were making investment decisions with pensions, with people's retirement on the line on the basis of faulty information. So my guess is the board is going to take whatever he gives them. And for the shareholders that are going to say, you're not getting this company for $42, Musk is going to say, well, if you think I'm getting such a great deal, roll in your shares with me, and we'll go private, and you can benefit from the IPO in 2 years after we turn the business around. And with that said, you could see up to 30 to 40% of shareholders roll in with Musk, and that could give Musk control of the asset for $20 billion, which is lunch money for Elon Musk. And it would be one of the greatest deals of all time, and he'll turn the thing around for sure.
Tom, I will say, to use a sports reference here, since we're in the midst of the NBA playoffs, it feels a little bit like bully ball from Elon Musk, if I'm being honest. A little bit of bully ball from him to get his way with this Twitter deal.
Yeah, well, he has the leverage. I mean, and we know that that's how he plays. Some people would never renegotiate a deal if they'd given their word on a particular price. He's not one of them, and whether it's right or wrong, fair or unfair, that's what he's doing, and that's what we're likely to see. I think when all is said and done, if you leave aside opinions about whether he should or shouldn't lower the price, I think improvements are coming. And I think that's the name of the game. I think you're going to see an open algorithm with no favoritism or filtering. I think you're going to see an edit button. I think you're going to see more characters. And I think the most important thing of all is you're going to see user authentication. Put up a driver's license, put up a passport, show that you're real. And then if you want to yell fire in an open theater, that's okay. It's just you're going to be held accountable for those actions. And there are consequences for doing that. You can have free speech, but you have to face consequences for your actions. And if you're an Android or an anonymous bot, you don't face those consequences, which is what has made the platform a little bit undesirable for many people. And with that new environment, I think you're going to have the re-engagement of many high-level inactive celebrities that are friendly with Elon Musk and want to see it succeed, because if they can find a way to reach 40, 60, 100 million people in a safe environment, they're going to want to do that. And I think that's what's coming to a theater near you.
All right, well, we will stand by with our popcorn time, ready to see how this plays out. Thank you so much for joining us.
I appreciate it, Corey. Have a good one.